Welcome to SB Talks. Today is Wednesday, June 21st, and I'm once again joined by our Chief Investment Officer, Nick Ryder. It is the season, Nick. It is central bank meeting season. We have a whole series of announcements in the last few weeks, and let's work our way through them.
Great.
So I'll pick us up right where we left off at the last podcast. That one was on June 6th. The RBA had just met and made their announcement. A couple of weeks on now, and we know a little bit more because their statement's out. Has that changed at all your views, or what more do we know about where rates are trending here?
I think, so yesterday we got the RBA minutes from the June meeting, and I would say they were probably a little dovish compared to the talk that had come out afterwards, so the post-meeting statement and Governor Lowe's speech following that.
I might just pause you there and for the listeners give us the benefit of the hawkish and the dovish.
Yeah, so hawkish basically means they're more likely to lift rates, and dovish means they're probably more likely to be on hold or possibly even cut rates. So that's generally people pass the commentary through that lens and try and work out which way the RBA is leaning based on the wording.
The instant reaction from the announcement the last day, or certainly in the 24 hours that followed, was almost not only we were getting a rate rise, but we were up for another 2, if not 3, to come very quickly. Has that receded somewhat?
I wouldn't say it's receded, but I think what's happened is the market has pushed back those 2 rate rises. So they were looking at possibly, back-to-back ones, July and then August, but now we're probably looking at July and then maybe November. So the rate rises are still there. They've just elongated the cycle.
Mm-hmm. And again, a lot of that was built into the expectation that perhaps Governor Phil Lowe was not going to be around after September, so that he'd want to get them done before he goes. But
yeah, so I think looking at the minutes, what did they talk about in there? Well, they talked about the decision being finely balanced. So that was certainly something that came through in the minutes. The other thing they did was they omitted a line that had been in the minutes previously, saying that further tightening might be required. That was in the last paragraph of previous minutes, but it was missing in this one. So the market took that as a signal that maybe they were done.
I love this hyper-analysis of these minutes. Did someone just forget to include that line again, or do we know?
Well, I think you might be right, because that line was certainly in the post-meeting statement, and it was repeated by Governor Lowe at a speech the following day. So I think he's still signalling that further rate rises might be required.
And we have had further labour data in Australia since then as well, which is certainly showing that employment situation is not easing up at all. It's a very healthy employment market.
Well, that's right. So a very strong labour market number, 76,000 jobs created in May. That was much stronger than expected. The unemployment rate ticked back down to 3.55%, which is only marginally above the cyclical low of 3.43 we saw late last year. And the participation rate, the number of people in the labour market, at a new cyclical high. We've never seen it as high, 69.6% of people in the labour force. So very strong numbers coming out of the jobs market. And we had Deputy Governor Michelle Bullock speak about the labour market yesterday, and she described it as still being very, very tight. There was a little bit of loosening that we've seen in the last few months. So what they call the underemployment rate, that's people that have part-time jobs that actually would like more hours. That actually ticked up. So that rose to 6.4%. Off its lows of 5.8. So maybe some signs of some slackening.
At the edges, yeah, but not enough certainly to be causing any about turn in monetary policy just yet.
That's right. And she said full employment, what they call NAIRU, the non-accelerating inflation rate of unemployment, so the rate of unemployment that's consistent with inflation not going up or down, that they think is around 4.5%. So that would imply that they need 140,000 jobs need to be lost to slacken up the labour market.
Okay, do you mind just taking us through that one more time? So how is that number derived? And I'm not familiar with NAIRU, so thank you for introducing that one into the lexicon.
Yeah, it's a number is a bit of a guesstimate. No one really knows where it is, but to put it in context, unemployment had been around 5 pre-pandemic. So 4.5% was a stronger labour market than that, and we're at 3.55 at the moment. Yeah. So
Very tight.
It's very tight, and there are still shortages of workers, despite immigration being fairly strong. There are still quite a lot of shortages of labour in certain sectors and certain pockets of the country. So
that's where they're saying that's where they'd like unemployment essentially to be from an inflationary perspective.
That's right. That's right. It's a trade-off between unemployment and inflation. So they actually forecast unemployment to rise to about 4.4% by the end of 2024.
Albeit you're not going to get a politician in a million years to talk about how they'd rather unemployment to be higher than it is today.
Well, that's right. That's right.
Such is the difficult work of central bankers.
That's right. The narrow path to the soft landing, as they call it.
Is the narrow path still there? Can we see it?
Well, we're still walking it at the moment. No one's slipped off yet, but it still looks like it's possible, but increasingly unlikely, particularly with inflation risks being tilted to the upside. So that's another thing the minutes spoke about, is the rise in house prices that we've seen since January, up 2.9% in the capital cities. That's not helpful for the RBA. We had the Fair Work Commission they referenced being higher than what they expected. They're seeing high inflation starting to get baked into wage claims and also businesses passing it on almost automatically, and that's not helpful. So they talked about a whole lot of risks around inflation being tilted to the upside, and I think that's why they moved in June and why they'll probably have to move again.
Probably in July, and I guess either way, nothing's going to be seeing interest rates stabilising or certainly getting cut anytime soon. So we are on this path for some time further yet. Since we last spoke, the Fed, the US Federal Reserve, has also met. And is it a skip? Is it a pause? Where do you land?
Yes, it's what they would call a hawkish skip.
Hawkish skip, okay.
That's right. So they skipped, but they provided a new set of forecasts, including what they call the dot plots. And the dot plots show the median...
Maybe just explain to the listeners what the dot plot actually is.
So the participants at the meeting are required to put a little pencil mark, if you like, against where they think interest rates will be at the end of 2023, 24 and 25. And basically...
Each pencil mark forms a dot, and you get all these collection of dots to see where everybody's thinking is at. And what is that? How is that trending, the dot plot?
So the median dot plot for the Fed funds rate at the end of this year has gone up from 5.125 to 5.625. Wow. So an extra 25 basis point rate rises by the end of the year.
Yeah, that's meaningful considering where they're at already. Yes.
So that's why it was termed a hawkish pause or skip, because they said, okay, we're skipping, but we're also expecting rates to be a lot higher by year end. That said, I don't think anyone's buying what the Fed's selling. I think it was a bit contrived, the dot plots, and I think they might. No one's believing that that's going to get actually delivered on. So market pricing doesn't have that.
I was just going to say, what is the market pricing? So you're setting a scene here where the Fed probably wants to just back off a little bit and give time for what's already. The rate rises that already occurred to play out, but they don't want to get everyone too excited, so they're going to put out a hawkish dot plot outlook, and the market said no. Yeah,
so the market only has one of those rate rises by year end.
Okay,
essentially 23 basis points by November, 18.5 by July. So everyone thinks July, and then they're probably done. Basically, that's what the market's suggesting.
And then see where inflation tracks and the economy goes from there.
Yes, and so I think the key thing is that Chair Powell indicated that while headline inflation's come down quite a lot due to the food and energy disinflation that we've seen since the Ukraine conflict began a year ago, core inflation is still much too high and has been very slow to come down this year.
Yeah, it's really, really baking in. If we keep on that journey and we travel a bit further, we end up in Europe, and we've had ECB and UK also provide central bank updates in the last couple of weeks.
So the ECB, yes, they lifted rates last week at 25 basis points as largely expected, but then they also were quite hawkish, Christine Lagarde suggested July was live, probably another 25 in July, and maybe even another one in September.
And for the benefit of the listeners, where are they at now in terms of their rates?
So the deposit rate is 3.5% there.
So still quite a bit behind the US and even here.
Yes. The Bank of England meets tomorrow night.
Okay.
Yes, and they're widely expected to either do 25 or 50. No one's really quite sure. Their inflation is still very, very high at 6.8% core inflation.
So plenty of work there to do as well. And we've seen a couple of technical recessions now be declared in the last month or so. So I think we've got parts of Europe and New Zealand, unfortunately.
Yeah, so Europe, Eurozone and New Zealand in technical recession in early 2023.
So that's 2 quarters of negative GDP growth.
2 quarters of negative GDP growth. I mean, I think it's not anything to get concerned about. For example, in New Zealand, part of it was due to inventory destocking.
Right.
So that was a big driver of their negative print in Q1. And Europe, similar, very minor contraction of 0.1%. So hardly a deep recession. And both markets still have very tight labour markets, as do we. So
certainly not enough for the ECB, for example, to want to step away from their current monetary policy tightening. So we watch this space, see if that technical recession turns into something more substantial. In China, we've a lot of expectation this year that they'd be turning on the stimulus cannons again, but it doesn't appear to be having the impact that it once did.
No, I mean, they cut key interest rates by 10 basis points over the last week or so. That was a little disappointing. The State Council met last week and everyone was hoping that they would announce some more infrastructure spending, and that hasn't come through yet. So everyone's been a bit underwhelmed by the Chinese response to the soft data that's come out in recent months.
They've done the
rebound.
infrastructure story so many times already. It's hard to think about what else there's left to do there. Are they possibly just running out of playbook?
Yeah, I think so. I think they're struggling. They don't want to do the GFC style splash the cash around because they're worried about financial instability risks. So I'm not sure what other tools they have in the playbook. Yeah,
and possibly one eye on their population as it begins to tip over and gradually head into decline as well. So
that's it.
Creating challenges there. And the space that we've spoken about before and expected to see some movement, but there hasn't been much up to yet, is the commercial property market here in Australia. And take Sydney as an example. We've actually, one of the biggest challenges we've had so far is that there's been so few transactions. Everyone has expected that higher interest rates and companies' increased work from home was going to see that market soften, and it should reflect in valuations, but valuations hadn't really moved at all due to the lack of sales in that space. Well, perhaps we are starting to see a little bit of movement there in the last couple of months.
Yeah, there was a few anecdotes. There was a report in the AFR about a Dexus, I think it was an A-grade Sydney office building that got sold at a 17% discount to its most recent book value. And that book value was only from end of 2022, so it was a December 2022 number.
17%. Okay, that's a significant adjustment.
A significant adjustment, but I think these things will start to flow through. We just need more, more selling, more transactions to see it. But certainly, the office space in Australia and elsewhere in the world is under a lot of stress at the moment, given work from home. Given higher interest rates and higher capitalisation rates. So it's a sector that most people are pretty cautious on.
We've seen some anecdotal evidence there of, as firms coming up to renew their leases, handing back 10% up to 25% of their floor space just because they don't need it anymore due to more hybrid working arrangements. So plenty to play out in this space with time to come, an area where we'll probably just be a touch cautious from an investment perspective.
Well, certainly on office, I think there are other sectors, that maybe look a bit better. So, for example, industrial is probably a space that's better, but it's obviously more expensive. Even retail got beaten up when Amazon came into Australia a few years ago, but things don't look maybe as grim as what that used to look like. So I think there are some other pockets, and then obviously there's these alternate property sectors like healthcare, where the dynamics are quite different. So I think it's sector specific.
Yeah, you want to be quite particular in terms of how you deploy your capital into that market. Lot to get through there, Nick. Thank you very much as always, and thank you to all our listeners. We'll catch up again in a couple of weeks. Until then, take care.
Thanks.